welcome. This is Paul Pappas from Mortgage Choice. Hope that you've all been keeping well. Welcome to our first market update for 2023. There's been a lot happening for the beginning of the year. So exactly what's been happening and how has it affected you and what can you do about it? Let's have a bit of a chat. Well, firstly, let's see what's been happening as far as interest rates are concerned. Interest rates have still been increasing ever since May of last year. When will it stop? Property values are starting to flatten after the correction that in many ways we had to have. Rents have been increasing sharply and renters are really copping it harshly over the last 6 months. Having said all that, with the level of property sales and so forth going not being as strong as what they have been, banks are still keen to write business. So what they're doing is rewriting each other's business and offering incentives of up to $5,000 for you to be able to refinance and obtain a better rate and move banks. So a good cash incentive is still being offered by the various lenders. So firstly, let's have a look at interest rates, and let's have a look firstly at exactly what's out there for owner-occupied borrowers. I should say from the outset that the variable rate that we've got there of 4.874% does not take into account this month's Reserve Bank increase. We're still waiting on all the banks to make their announcement. We do expect them to increase by the 0.25%. So you can expect variable rate to be up around that 5% level, and fixed rates up around that 5.5%, as you can see. And in fact, a lot of the banks have started to increase their fixed rates further, and they're getting closer to 6%. So we're still seeing a gap between fixed and variable rates. So variable rates are now starting at 5%. But fixed rates, they're still unattractive at current levels and not necessarily something that we're recommending in our book, in our eye, I should say. Why would you fix at the expensive end of town in terms of when interest rates are fixed? Unless, of course, you just want to lock yourself in to give yourself some peace of mind. As far as investors are concerned, look, again, the variable rate doesn't take into account this month's move, I should say. So you can expect variable rates to be around that 5.25 mark, and again, but still relatively cheaper than fixed rates. Fixed rates again being around that 5.5% mark for investors and being more expensive. Our advice is for both owner-occupiers and for investors is to ride out the variable rate as best you can, for now at least, until we see some more attractive fixed rates come through. As far as the property market is concerned, well, we are seeing a flattening out of the property market, with Sydney property values decreasing by a relatively low percentage of 0.6% in the last quarter. So what this indicates is that the market itself is starting to flatten, and we are at the end of the correction that we've had over the last 12 months. And in many ways, that was a correction that we had to have after a very strong increase in values, and of course interest rates have been going up as well. Property values have increased, or decreased I should say, around 7 to 8% from their recent peak. So we are now seeing that the market is flattening out and a new level of property values is being established at our current levels. Buyers remain cautious, mainly because of higher interest rates and also because borrowing potential is now about 30% lower than what it was 12 months ago. So what it means is that buyers have got 30% lower loan ability or loan monies to be able to go to the market and purchase property. So what this of course created was a correction in the property market, but which is now flattened out, and that's what really caused the downturn and the correction that we needed to have, because buyers simply couldn't borrow what they could 12 months ago, and a 30% reduction is quite significant. When you do get property values coming off, vendors always hold off. So what we're seeing is that the level of stock or level of properties that are out there for you to purchase or give consideration to is much lower than what it was, and stock levels are quite tight. Having said that though, with stock levels being quite tight and reasonably level of demand out there, we are seeing so far this year a good increase in auction clearance rates, with the most recent being at around 70%. That's actually not a bad number, and a quite strong indicator that if buyers are out there looking to buy property and they find the right property and it's being auctioned, it's being sold. So that 70% clearance rate is actually a very good number. The big one, of course, is rents. Rents are going, to be perfectly honest, they're going through the roof. In the last 6 months, we're seeing rents increase about 10% per annum. And we're hearing some pretty sad stories of renters having to bid and queue up to look at renting a property, and this has been caused by a continued shortage of rental properties. We're just simply not building enough. We're not investing enough in investment properties, and with an increasing level of migration and population and demand for rental properties, we are seeing a huge imbalance in terms of demand and supply, and that's why you're seeing rents increasing to the levels that they have been. They are, and it's quite getting very tricky out there. What do we expect to see for the rest of this year? Well, we do expect the Reserve Bank to continue, probably with one more increase next month in April, but then they're certainly giving some strong indications that they're ready to start looking at pausing. And I think the word pause is critical in terms of sitting back, analysing the data that's coming through in terms of the inflation numbers, the unemployment numbers, economic activity and confidence, to see exactly how the interest rate moves over the last 12 months, how that's affected the economy in general. So we do expect the Reserve Bank to start very seriously looking at pausing. So that potentially means that interest rates have peaked. And with interest rates have peaked, we do expect that the property values will remain unchanged. And we don't really expect to see a lot of change in property values this year. We feel that the property values have bottomed out, and we've certainly seen in the last quarter very, very little change in property values, and I think you can continue to expect to see that for the remainder of this calendar year. As I said before, there is a massive shortage of rental properties out there. So one area that we will see change is that rents will continue to move. And what we're really seeing is that renters are looking at now purchasing property. So you've really got to ask yourself a question in terms of, is it cheaper for you to rent or is it cheaper for you to buy? And so we're more than happy to have a chat with you about that as well. The recent changes to stamp duties for first home buyers up to 1.5 million means that this will create some more activity from first home buyers and provide some incentives for first home buyers to look at property, especially in the area of units. So essentially, if you're buying a property for up to $1.5 million and you're a first home buyer, there'll be very little stamp duty involved, and the costs are very minimal for you to get into the market. The big R word still gets thrown around as far as the media is concerned, and of course I'm talking about the word recession. I personally find it hard to understand how we can enter a period of recession when you've got plenty of jobs around, low unemployment rates, and if you've got a tight, we've got plenty of pressures on the household budgets and so forth, but at the end of the day, there are jobs out there for everyone, for anyone to look at and increase their household income. So with low levels of unemployment and strong employment opportunities out there, I just find it hard to understand how we could possibly enter into a recessionary type environment. We'll see. So what should you do? Well, if you're a buyer and you're out there looking, there's never been a better time to buy in terms of property values have stabilised. We've now got a new level. We don't have as many buyers out there as what we used to. So therefore, if you find the right property and it ticks all your boxes, why would you want to be competing for that property with a whole heap of other buyers at potentially higher levels when the levels of demand pick up? So buyers should be looking at buying now and avoid the competition of bidding for property later on and buy it at today's prices. We've got the bottom. Renters, well, look, as I said before, renters are really going to be under pressure, and renters are getting to the situation, well, if you can afford the rent, you should be asking yourself, okay, well, if I can afford the rent, can I afford a mortgage? There's plenty of government incentives out there in terms of stamp duty and other government incentives for first home buyers to enter the market. So have a chat to us about, if you are renting, have a chat to us about entering the property market and purchasing your first home. Because as I said, if you're able to afford these increasing levels of rents, chances are you can afford a mortgage. So renters, that we are already seeing a move of people moving away from rental properties into buying properties so that they're no longer being forced to pay increasing levels of rents. Borrowers, look, if you're an existing borrower and you've got your mortgage, we're seeing lots of situations of people who are coming off interest rates of around 2% now paying around 5%. So that's 2.5 times increase in your interest rate and also the monthly repayment. So you really need to renegotiate and talk to us about your home loan to try and save you some money. We'll give you an example later on. At the end of the day, don't sit back and watch both your rent and your home loan repayment increase, because this only just puts pressure on your own family budget. All right, so you should be reviewing your situation, talk to some experts like ourselves in terms of how we can lower your cost of living, certainly in terms of your home loan, and get you into the property market if possible as well. So here's an example of what we recently achieved. We had some clients who recently came off a 3-year fixed rate of around 2%. Their current lender was offering them 5.34, so quite a significant increase. And in fact, that meant an increase of about $1,200 a month on their home loan repayment. We're able to obtain a lower rate from another lender, it saved them 0.5% on their interest rate, and at the same time get a cashback of $4,000. So overall, what this did for our clients is provided them with a year one saving of $6,500. So this is where it's important that you're coming off a rate of 2%. You're going to go at around 5%. So yes, it will mean that an increase, quite a significant increase in your monthly repayment, and unfortunately, you just need to meet the market in terms of where rates were and where they are today. But if we don't shop around and review your mortgage for you, it's going to be very difficult for you to save money as best you possibly can. And there are still some great opportunities out there for you to do so, and some significant savings that we can negotiate for you that will provide some savings for you so that you're not incurring that massive increase on your family budget. So look, at the end of the day, there's a QR code there for you. We do like you to have a chat to us, have a scan of that QR code to book an appointment with either Ryan or myself to have a chat about your situation and how we could save you some money and put you in and change your circumstances to get you better positioned for your way forward. Please do not hesitate to scan the QR code in front of you, book an appointment with either Ryan or myself. We'd love to have a chat to you and help you move on with your own situation. Please keep well, and until we talk again, look after yourselves. Thanks.